So hi everyone, my name is Karolina, and this is my work with Ramakont from Mash Institute. And I will be presenting on the dynamics of sovereign debt, credit risk, and the sustainability. And just quick acknowledgements, the GeoSep funding from the European Union Grant Horizon is helpful in the research. So this is a bit of the outline. First, I will motivate the model, then I will present the model itself, which is a new framework for sovereign debt dynamics modeling. Then I will talk about parameter estimation, and then I will jump to the empirical results. We basically calibrated the model to Argentina and Greece. So we'll talk about those examples in turn. And then I will talk about how we can use this framework for policy analysis and sovereign debt sustainability analysis, often performed by IMF. And then the last section is more for the academics, which is the analytical results, the properties of the models of the model, and so on. Okay, so a bit on the motivation. So sovereign debt class is expected to surpass 100 trillion in 2025. The global public debt to GDP ratio is approaching 100%. That's hugely due to borrowing after COVID, during COVID. And according to IMF report from 2022, 60% of the countries were facing debt distress in 2022, which is double to what was happening in 2015. And for monitoring sovereign debt, investors often rely on credit ratings, which are qualitative, not quantitative. There is no transparent methodology. We don't know how they're being developed. And then there is, in general, a lack of empirically validated quantitative framework for sovereign credit risk modeling. And there is huge literature on the corporate credit risk for firms. And there are two types of models: the models that are focusing on insolvency and illiquidity. So insolvency occurs when the total assets fall below total liabilities. And that's easy for firms to establish because you look at their balance sheet, you compare the assets, liabilities, and you know where you stand. And illiquidity occurs when you just don't have enough cash to pay your ongoing debt liabilities, which means that you don't have enough liquid assets and you cannot borrow enough to cover these current payments that you need to make. And most of these corporate models of credit risk are based on insolvency, so assets versus liabilities. But the problem for sovereigns is that sovereigns differ a lot from firms. And first thing is that it's really hard to say what are assets of a country. If you think about public land, the islands, all the public firms, the people, like the government is not willing to sell those to repay the debt obligations. It's also not the case that when a government defaults, the creditors come and claim the assets of the country. So there is no enforcement mechanism for repayment. And because of that, the concept of insolvency is not really relevant or helpful in the standard terms for modeling sovereign credit risk. There is also, government-specific budget flows, the tax revenues, social security spending, and so on. And because of that, we focus on modeling the liquidity of a sovereign. So our model will focus on the liquidity inflows and outflows. And well, there are some qualitative models of sovereign debt, but they are not always easily amendable to data. Our model is very data-driven. And there are empirical papers, but there is a gap between how empirics are done and how theory is done in the sphere. So we propose a quantitative model of sovereign debt dynamics and sovereign credit risk. It is a structural model, so it accounts for the sovereign balance sheet structure and its dynamics. We model the government and private sector investment and credit supply by the financial markets. And the equations are based on relations between economic variables, but it is still analytically traceable model. So we can derive analytical results, which will be at the end of the presentation. And we achieve good agreement in sample, realistic dynamics for variables, conditional on output pathway, for long horizons of up to 10 years. The model generates realistic sovereign credit ratings based on transparent methodology. On a granular level, you can back out the sovereign credit ratings out of the model. And it's a quantitative framework that could be used for debt sustainability analysis, fiscal stability analysis, and policy. So now, yes?
When you said output, I guess that just
GDP.
clarify GDP.
Yes. So it's hard to predict GDP.
Yeah.
We don't try to do that. But the IMF, when they do shock scenarios, they usually assume output pathway and do conditional on that. We do exactly the same thing. So the model is a multi-period model, and it describes interaction of three entities. So we have the government that balances its budget. It invests in the economy through the gross fixed capital formation. It borrows to cover the budget deficit and roll over its debt. The debt in the model is multi-period. We have domestic private sector, which basically just invests in the economy and contributes to growth in that way. And we have international financial markets that provides limited credit supply to sovereign. So the government cannot borrowing insane amounts. There will be a cap on the credit supply. And the financial markets determine the cost of borrowing, so the interest rate at which the government borrows. And they also determine the credit rating. And in the model itself, we have only high yield and investment grade, but we can use the model, which I will show later how, to back out the granular credit ratings of like AAA and so on, right? And the default in the model occurs if liquidity outflows exceed liquid inflows. So there is a liquidity shortfall that cannot be covered by the borrowing. So the amount of credit available to the government. This is the core of the model, the budget flows of the government at time t. So we model the interest expenditure, government investment, government spending, principal repayment, which doesn't go into the expenditures in the national accounting. And we have, based on the deficit, which is just the outflows minus the inflows, the demand for new borrowing is determined, which is basically you take the deficit, you take how much you want to roll over your debt, you add that up and you borrow that amount. If you have a surplus, you borrow a bit less. But this is in almost all cases positive because the order of the rollover, that how much the principal is usually higher than the deficit.
So
yes,
maybe I don't quite understand. Is this the deficit or just the amount the deficit increases in a given year?
No, this is the deficit in a given year.
In a given year.
Yes.
So the total deficit is going to be the sum of all the past deficits that are still due, right? Or is there a term in there that's accounting for the rollover of the old debt?
Yes. So the rollover of old debt is PT.
Okay.
And HT is the deficit in the current period. And PT is the rollover of debt.
All right.
And that's
accompanied by the repayment.
Yes. Yes.
Okay.
Yes.
Which will depend on interest rates. And
yes, exactly.
Okay, fine.
Yeah, so we represent all the variables in US dollars. So in the base currency in which the most of the debt is denominated, because we care, well, I will talk about the issues with inflation and FX later, but we basically model everything in the main currency of the debt. Okay. A bit of questionable things. So this is how we model the output of the economy. So the GDP, it's an ARX process with additional investment, which allows us a feedback loop between the investment of the private sector and the government into the economy. So when the investment falls, the output decreases, and that's in line with the accelerator effect theory of investment. And we also have multiplicative shocks, which is standard in the literature. And this you can put any distribution of shocks that you want, but we will be using heavy tails distributions because of the evidence that the shocks to GDP are usually heavy tailed. And And then the private sector investment is also an ARX process, but we additionally put the tax rates here, which basically the intuition behind this equation is that the private investment will fall when the tax rate rise, which is in line with the empirical evidence on the effect of taxes on investment, and it will increases when the growth of the economy increases. Okay.
So are you putting in a trend so that GDP is growing? Or I guess you can do that if you want.
Those parameters, both of these processes are calibrated based on multi-period prediction of those models on the empirical data. So not one period performance, multi-period, and that's why it's like a more complex optimization. But the parameters we get lead to growth because if you look at the past, for most countries, there has been a steady growth. So you have the parameters lead to steady growth. But then when you have the dynamics of private and public investment changed in the model can generate stagnation as well. Okay, and the government in the model is an actor. It has two fiscal instruments that it can use to stabilize the growth, to stop the growth of debt. And there are simple rules that could be improved after talking with governments, but they're just supposed to be like a proxy. So we have that there are two tax rates, either a high tax rate or low tax rate, and the government switches to the high tax rates when the debt to GDP level is too high. And that's also, there is some empirical evidence that this is what happens. And also IMF, when they negotiate with governments, they usually ask for higher tax rates. And the second fiscal policy is that the government has a desired level of investment in the economy, which is basically a fraction of its tax revenues. So government wants to devote beta of its tax revenues to investment, but it lowers this fraction to beta minus phi when the cost of borrowing is too high, because, well, this spending is partially funded by borrowing. And there is also empirical evidence that the cost of borrowing is tied to investment.
So when you say the government invests in the economy, it's like they're building
Infrastructure.
jet planes, I mean, war stuff, that's an investment too, right?
Yeah, I think I would need to double check the numbers. This is calibrated gross fixed capital formation of the public sector. I would need to double check whether military spending is there as well. Okay, so that was the government. And then we have the financial markets part. So we have a credit supply that is limited and is tied to credit rating. So basically we assume a cap on credit supply. And if the government is downgraded from investment grade to high yield, so junk bonds, then this cap is further lowered. And the idea behind, the motivation behind it is that lots of financial actors like pension funds are restricted by the regulation into whether they can be investing in high yield products. So that basically represents them backing out. And we also have the sovereign credit rating, again, only two grades, high yield and investment grade, and that's tied to the spreads. If the spreads increase above a threshold that is calibrated with historical data, then the sovereign gets downgraded to investment grade, to high yield. And the default in the model occurs when the debt demand, which is based on the sum of deficit and principal repayments, so the rollover of the debt plus the deficit, is greater than the credit supply in a given period. Yes?
Just to fix ideas, what sort of numbers have you got in mind for WMAX?
So it depends heavily on the country. So WMAX is calibrated using historical gross financing needs of a country, which is the sum of short-term debt, so term debt maturing within 1 year, and plus deficit. So for Argentina, historically, that has been 11% of GDP. That's why it's kind of tied to GDP. For Greece, we use the highest gross financing need in the training period of the EU monetary EU countries. And that was Italy, and that was 39% of GDP. Which, you know, you could make like you could use different figures for that. But what you care about is basically the distance between this cap and this borrowing need process. And this borrowing need process involves that the shock distribution from the output. So this.
And it's the extra bonds you issue in a given year.
Sorry?
Is it the extra bonds that, sorry?
Yes.
T-soup is a upper bound on the amount of bonds that a government can issue in a given year.
Yes, it's not
the stock of bonds in
No.
total, because we know that, like you said earlier, it's around 100.
Yes, it's the single year,
percent.
and it's not only bonds, it's also, to some extent, it's also loans, right? Because some of this short-term debt was issued as loans.
Yeah.
Yes?
Yeah.
And then the underlying currency is not considered?
So the underlying currency is the main currency in which the government usually borrows. So for Greece, that would be euro. For Argentina, that would be US dollar, partly because this is a model of default and countries very rarely default on internal debt. They mostly default on external debt because they cannot use monetary policy to dilute the value of the debt. So somehow unrealistically, most of the debt is treated as an external debt. And that could be adjusted, but basically we model everything in US dollars, and then if you have a FX change, we model it as a shock to GDP, which is basically from the GDP in peso, even if it's stable, you have an FX shock, so the GDP in US dollars would be different. Okay, so how do we model the spread? This is the standard equation. So the spread, the difference between the borrowing cost and the risk-free rate, is the probability of default, market estimate of the probability of default pi, times 1 minus the recovery rate. Recovery rate we assume constant and take from historical data, which is quite unrealistic because the investors actually don't know the recovery rate at the time when they borrow. And we estimate the market implied probability of liquidity, so that the probability of default is the market implied probability of liquidity shortfall the following year. So the probability that the debt demand next year is higher than the debt supply. And this debt demand is this function of deficit and principal rollover. And then the deficit is a function of how much you borrowed last period and the output shock you expect next period. So we can rewrite it, making some assumptions about what investors think the budget dynamics will be next year. So we can write it as a function of the interest rate, which is still to be estimated, and that this is greater than this output shock next period. And then a lot depends on what is the assumed distribution of this output shock. And what is the standard deviation of this output shock that the investors assume. And if you think about it, this standard deviation of the output shock that the investors assume should be higher than the historical one, because investors in our model are risk neutral. There is no risk premium, while in reality, most investors are risk averse. And there is also no uncertainty about this recovery rate, while in reality, the uncertainty is big. So we would expect if the assumed shock distribution is the same in terms of, it's like a fat tail, it will have a higher standard deviation here than in the underlying output process we put in the model. Yes, Dwayne?
So equation 13, what is the thing on the left?
So that's output. Yeah, I just changed the calligraphy of that because in here we use the standard deviation and the shock distribution that the investors assume, not the objective one. So we have the output.
This is the expected output.
Yes.
Okay.
This is how the investors model output.
Okay.
So I put.
And I don't quite see following this equation. So you define pi, but then you don't use it in 13.
Well,
Or am I-
because the 13 is actually inside of pi.
Okay.
Because the 13 determines that demand next period.
Okay,
Oops. But I didn't want to write this whole z function, which is a complex function
Yeah,
of
yeah.
all of the things that I put in the model. But basically, what I wanted to stress out is that there we have this important parameter sigma, which is the investor's perception of the shock distribution of output, which will be important later on. Yes?
You go back a couple of slides. Do you mind? Oh, well, no.
Can we actually continue and then
Yeah.
at the end, because I'm running,
Yeah.
I still want to take some questions during, but let's progress a bit. And then we have the whole accounting identities for that dynamics, which are just accounting identities. So the principal repayment is based on the old stock and we model it in real terms. So we adjust for inflation. The new debt stock is based on the old debt stock minus the principal repayments plus the new borrowing and so on. So all of this is just simple accounting. And then there's the model timeline. So in each period, we start with shock to GDP. Then the domestic private sector invests. Then we have the government doing the public spending, doing investment, collecting revenues. It balances its budget, so it determines how much it needs to borrow. It announces the tax rates for the next period because there is a lag between tax reforms and the implementation. And these new tax rates are accounted for in the investors' models. And then the government goes to the financial markets and says, hey, I want to borrow this amount. And then if the credit supply is enough, then it borrows. If it's not, then the default occurs. And then using this spreads equations, the market determines how expensive the borrowing will be. And basically in here, you take those two equations and it becomes a fixed point equation where you jointly determine the borrowing cost R and the probability of default. And then based on the spread, there is the new credit rating, which will be applied next period.
how do you model financial markets?
So it's just this set of few equations.
That's
So-
the financial market.
Yes, that's the financial markets. This and this, which is the credit supply, credit rating, and the spread. So there is no decision per se. Okay. So parameter estimation.
Could I just recovery rate? What does that mean exactly?
Recovery rate. So when you issue debt and then you default on this debt, it doesn't mean that you give 0% back. You usually give a fraction of it back. So lots of those things you can kind of use observe data to have. So like average maturity you can take from the World Bank data. Recovery rate, we use the haircut estimation from they examined 200 years of sovereign default and so on. Then for the processes for output and in private investment, we estimated multi-period prediction models. And then the policy parameters, I kind of simple rule of thumb things. And I think the goal of the model is to collaborate with governments and use their opinion on what policy parameters should be. Then for some of the things we needed to use data proxy. So for example, the maximal credit supply is based on the highest gross financing needs figures in sample. And the only free parameter of the model is this standard deviation of shocks, the perception of the standard deviation of shocks of the investors. And we calibrated based on the matching on the fit of the spreads in sample. And we usually get like 4 to 7 times bigger figures than the historical standard deviation of output shocks that we observe. Because this risk adjustment of the fact that we model risk neutral while they're actually risk averse, and because that's the only source of uncertainty in the model. Okay, so now we move to the empirical results, which is we basically calibrated the model for Argentina. We estimate the parameters using the yearly data between 83 and 93. So 10 years of data, and the standard deviation of the output shocks using the data from 90s to 93 quarterly, because there was a default in 89 and the calibration was not stable before, so we needed to limit the period. And we assume a heavy tailed shock distribution as it's evidenced in the literature. And we initialize the model in the first quarter of 1994, and we simulate scenario conditional on historic output pathway. So we take the output pathway of the Argentina in the period that we simulate, and we feed it as y t minus 1. So it's a one-factor model in a sense. You take the output and you simulate everything else. And we add the shock in 2002, but it wasn't significant because even without the shock, the Argentina defaults, but 4 quarters later. So what happens in the model? The model predicts a default in the first quarter of 2002, 1 quarter after the actual default, and 8 years, so 32 quarters after initialization. It generates realistic spreads, assuming a realistic recovery rate, and forecasts the dynamics pretty well. And I will show you the picture.
So that's amazing. You're saying you forecast 8 years ahead.
Yes,
and only missed
but
by 1
conditional, conditional out on output, right?
On the
So
output,
it
okay.
knows the output from the previous period.
All right.
And that's it.
Right.
So in here are the dynamics. So x-axis time, y-axis depends on which plot you are. So we have stock of debt, interest payment, balance, private investment, credit rating, and bond spread. I think the most interesting one, the coolest one in a sense, is the bond spread. We forecast that really well. We kind of overestimate the balance, which leads to lower debt, which leads to lower interest payments. So yeah, the data is in green and the model is in blue. But yeah, I think the most interesting here is that we, in the spreads, we kind of match not only the levels, but also the dynamics. And you can see here that the spreads actually rise even before the FX shock, which is applied in the first quarter of 2001. So if we simulated it without the FX shock, because for the whole period, the Argentina was pegged to US dollar. And in the first quarter of 2002, it was released. So that's why you have this jump. But if we don't apply this FX shock, we still have a default just 4 quarters later. Yes, Jeremy?
There's this saying, which I can't repeat exactly. I don't know the detail, but it's something like bankruptcy happens very slowly and then briefly, very quickly.
Yes,
is this something you can explain with your model?
Yes. Yes, exactly. I will actually get to that later.
I just want to be sure I understand what the forecast. So what about the tax rate and government interest rate setting and all that other stuff? You're assuming some default value for that for 8 years, or is your forecast conditional on those things too?
We assume that the government starts with the tax rate of the mean tax rate in the previous period. And then we assume the government can increase the tax rate to a higher tax rate, which is 10% higher than the mean tax rate.
So the tax rate's endogenous in your model?
Yes, and the same investment levels, it can also cut investment. And if you actually look at it will be more visible for Greece, but it basically acts within, like there are a few quarters in which the government inside of the simulation changes its policy to prevent the debt growth.
So it's just conditional on future GDP?
Yes.
Now, of course, investment and stuff affects GDP.
Yes.
So your internal dynamics might not be consistent with the GDP that's actually realized.
Yes, so we basically get the GDP from the next year and we use our equation from the previous year, and we use our equation to estimate the GDP in this year, and that the GDP is used in the model. But this estimate might be different from the actual realization, but we didn't want to be nowcasting, because you could be taking this GDP in the given year, you can do that with the model as well, right? And feed that and you completely ignore our equation for output. So that's Argentina, and that's, I will jump quickly to Greece. Yes.
So every quarter you estimate 1 quarter or forecast 1 quarter ahead or 4 quarters ahead?
So we take.
I mean, given you take GDP, let's say from Q1 2000.
Yes, and in for the Q2 2000, I use the GDP from the previous quarter, right? And I forecast and I estimate the GDP in this quarter and everything else for this quarter based on the previous dynamics of the simulation of the model. And I do this quarter. And then I go to the next one. So it's quarterly. But there is this thing that when you announce the tax rates, you need to wait a year for them to realize.
And now, like you said, maybe that's better for the discussion.
Okay,
but I'm
then let's.
not there.
Yeah. Okay, so now Greece. We estimate using quarterly data because we had quarterly data for Greece from 2000 to 2007 because that's the amount of data we had. And again, student heavy shock distribution. And we, again, starting the first quarter of 2008, and we take the historic output pathway for the following years. So it's conditional on this historic output pathway. And for Greece, we assume there is no cut in credit supply after downgrade because Greece could count on the support of the monetary union that was much beyond what any emerging country can face. And again, model predicts default in the third quarter of 2011. So that's 16 periods after initialization, actually 15. And at the time of Greek restructuring, before I think here, predicts a downgrade of Greece to high yield in the third quarter of 2010, 1 quarter after the actual downgrade, and forecast the dynamics well. So, well, the picture. So again, x-axis is time, and then we have stock of debt, interest payment, balance, private investment, credit rating, and bond spread. So in here, we see that the bond spread actually jumps, right? We don't forecast it as well as for Argentina. It's like starts increasing, and then we have a drastic jump. And this adjustment here is the policy action. We don't forecast the balance that well. Well, partly because like those are revised figures. The data you see are the revised figures for Greece. Our estimate probably is closer to what they were reporting at the time. And we also, in here, Greece underwent massive fiscal reforms. Our reforms happen like a year later, but they're not enough to kind of stabilize the budget. Because we have a threshold rule, the credit rating is a bit jumpy, but I will show how to use the model to have a much better granular credit rating estimates. But the stock of debt is very well tracked, partly because it's highly correlated with GDP, which we assume. And the interest payments do also really well. And we have the default here is, it should be 2004 there. Sorry, it was 2011 fourth quarter. And yeah, our private investment actually falls to 0 because of the falls of GDP in that period. Okay, we'll skip that. And then the thing I think is the most important, the coolest part of the model. Because here, well, it's conditional on output pathway, and good luck to people who want to predict GDP. I think it's a very difficult problem. But the way the governments operate and the way IMF operates is like, you know what you have up till now, okay, what's your like probability distribution of your output of your debt dynamics. Like you can come up with a scenario of the output and condition and all that, or you can think about ensemble of scenarios and see how your debt behaves as a response. So according to IMF definitions, public debt is sustainable if the debt stabilizes with low refinancing risks under a feasible set of fiscal policies. So that's why we include policies in the model, because for the debt to be sustainable, it doesn't mean that the fiscal policies need to be kept as they are. They just need to be changed to feasible ones. And yeah, we want a probabilistic model in its nature because we want to see whether that is sustainable with high probability. And we use the model for this exercise that we do the DSA for Greece in 2004 and 2009. And to do that, we basically calibrate the model until this quarter. We have no assumptions about this future whatsoever. And then we initialize this model in that quarter for 4 years, so 16 quarters. And we assume we model the output according to equations in the model, assuming a student distribution of the shocks and historical standard deviation of the shocks for the output, right? For the perception of investors' perception of output, we still use the one we estimated on spreads. So that's the 4 times difference between one and the second parameter. And so basically this is for so the first graph here is for 2004. We initialize in 2004 first quarter, and those are all the debt pathways simulated over 15 quarters here. And the green ones are the ones that survived, and the red ones are the ones that ended up in default. And the second graph is for the initiation in 2009. So you see that like much less pathways ended up in default over this 4 years for 2004, and much bigger fraction of the pathways ended up in default over 4 years when initiated in 2009. And
What's the difference between the left and the right?
so this one, the A was initiated in 2004 using calibration up to 2004 and in initial conditions from 2004. And this one was initiated, the second one was initiated in 2009 using calibration up to 2009. Yes, Jeremy?
You say speculated a big source of the difference was due to the initial conditions and perhaps most importantly the stock of debt in Greece.
Yes. Well, the initial, so I can run sensitivity analysis to see what was the most important bit. The stock of debt is like a high factor, but the deficit is also a very high factor. Because the deficit in 2009 was deep. Right. Especially because we have the actual, the real data, the corrected versions of data. So in here we have the numerical comparison. So basically 0.3% of scenarios led to sovereign default over 4 years in the 2004 case. And having this cumulative default probability over 4 years allows us to compare it with the numbers per class, per rating class of S&P. Because when S&P gives rating A or AAA or whatever, they have an associated cumulative default probability over time. And in that way, we can use the model to back out what would be the model implied credit rating. So in that case, it was A. But in 2009, 6.4% of the pathways ended up in default, and that implies B rating, while at the time S&P was still rating Greece as A minus. But again, we had the revised figures for deficit and debt. And we can also see, well, the policy tools in when we simulate from 2004 onwards were activated in 6% of the scenarios, while in the 2009 case, 99% of the scenarios used policy activation, which meant that, well, if I was IMF, I would be like, oh, maybe not very sustainable in 2009, right? I would need to have precise definitions of what high probability is, but we see that policy was very much needed in 2009. Yes?
Can I just ask a bit about the policy tools? I noticed they're all a bit kind of austerity IMF.
Yes.
And obviously we have brilliant Prime Minister Liz Truss.
Yes.
So, let's grow our way up. You've only really given options to these countries of going into the austerity, or going into austerity. Does your model tell us something about the potential of a sort of growth out of debt type policy?
Well, you can change the parameter values to make to go from austerity to actually boosts. Yeah. But we also have a bit later, I will be talking about how you can use spending investment to boost growth and how this growth can lead to, but you need like quite specific conditions for that to happen. Okay, and now the cool thing is I showed you 2 quarters, right? Initiation in 2 quarters, but actually you can do it for every quarter as you go along, right? And that gives you model implied credit rating at every quarter. So this is what I did here. So I started initializing 2004, ran for 16 quarters, used the figures from that to estimate the credit rating in that quarter, moved to next quarter, ran for 16 periods, 5,000 simulations, estimated the credit rating, and so on. So in here, X is time, Y-axis is the credit rating, and in red you have my model implied credit rating, and in orange you have the S&P rating. So we see that we downgrade earlier than S&P, but again, revised figures, and we assume this policy on the part of the government. But they kind of follow the same dynamics, right? And it's actually, I actually was very happy. I have no idea what was happening in 2004, but like we also get this little bump down from A+ to, well, we don't have the A+ or A- because they don't give you classifications for this, but like we also have a tiny bit of a downgrade there. And again, so basically you can run it at every period, and that gives you this cumulative default probability over 4 years. So I now plotted the cumulative default probability over 4 years at different initialization, and I did it for 3 different types of modeling. So no policy adjustment, that's the orange one, so that moves the curve to the left. Then the baseline policy, which is the blue one, which is what I used to get this graph. This graph originates from this blue graph here. And then extreme policy, which is the higher adjustment, it moves it to the right. So this is how, like, you can see the policy. And again, this is the fiscal austerity policy. But Greece, when I'm like, for other countries, growth could have worked. I checked for Greece and it didn't. Like, it needed, according to the modeling, needed fiscal austerity. And this is exactly what I will be talking about now, that if you think about the policymaker, the key questions for the policymaker at the time of that crisis is the size and the type of fiscal adjustment necessary to stabilize debt, the effectiveness of bringing the debt down, and the damage to GDP that your fiscal austerity will inflict. And we do that for Greece. We basically vary the parameters of the tax adjustment and investment adjustment. And we see what will be the impact on the final debt to GDP and on the output growth and on the stability of the economy. And we do it for the first quarter of 2010. And I chose this quarter because this is the first quarter in which you just run the simulation without output shocks, using the equation for the output we have in the model, but no shocks. Then the model defaults in that scenario. So it's the first fully endogenous default in the model. If you initialize in 2010. So we basically, we vary the investment adjustment, which is the x-axis, and we vary the tax adjustment, which is the y-axis. And in the panel A, we have what's the effect on the cumulative output growth over 4 years. And on the second, you have the final debt to GDP ratio after 4 years. And here is regime classification. I will come back to it. But in here, in general, blue indicates better and red indicates bad. And you could, Jeremy, in theory, you could vary this parameter in the other direction to have more like growth-based measures. And I did it for other calibrations, and there are specific sections of the state space in which it would work. But for Greece at the time, you couldn't escape stagnation or actual like a recession with the with the range of policies considered. And the debt to GDP ratio would grow. If you considered the minimal adjustment to avoid default, it would still reach 175% of GDP after 4 years. So we're talking 2014. And in here, we kind of did this additional thing in which we classified the way the model, the simulations into stable and unstable simulations. So when you have oscillation of that around a level that's unstable, and you can have growth, which is more stable dynamic, and we classified them into stable bad, which is the worst. So you are bad and you're going to be bad. Then unstable bad, when you're oscillating near bad, but possibly a shock can kick you out to a better regime. So we had stable bad, unstable good, and stable good, kind of traffic light system with additional one. And we see that in Greece, in 2010, it was fully in the bad regime. and like only very drastic policy adjustment would bring it to a more stable regime. Yes?
So here Yanis Varoufakis,
Yes.
you're saying, look, we're just going to be stable bad, whatever we do. So why do we inflict austerity on our people?
Well,
It's not, and if it means that it all comes to a head a year earlier, too bad. Let's have the showdown with the EU a year earlier.
I think to some extent, I'm not going to make this judgment, but there are opinions that if Greece defaulted, it would have been better off because it's still struggling with the high debt burden. But it's a question, like, I don't want to answer this question. I think this tool applied a few years later would say, oh, you should have done something. And I think it would be a bit unfair to judge the model by the conclusions it gives in a very like bad conditions. I think what I would like the governments to do is possibly, like kind of run that kind of analysis earlier and see whether the fiscal adjustment should have come earlier.
My friend John Giannakopoulos strongly advised the government to default right at the beginning because he said you're going to have to default no matter what.
But there is a lot of political discussion
I
I
think
don't
there
want to
would've
get
been
into. So yeah, that's what I talked about. So yeah, so basically we have very simple policy tools, right? And we have just the directional things, but hopefully if we collaborated with the government would be, oh, actually we don't want to do fiscal austerity, we want to do something else, or maybe we want like progressive tax rates. We could incorporate that in the model and run the same kind of analysis with those new tools. And now moving to the last bit, which is I will talk for another 5 minutes and then we can have a discussion. So for the analytical results, as I said, the model is small enough to be tractable. So we can actually calculate sensitivities and see the impact of one variables on the others. So the cool things is that we get roughly what we want, right? So we have that the default probability and borrowing cost increase as that increases. So that's like a very sensible, that's what we would expect to happen. And we also have that the default probability and borrowing cost fall as output increases. So you're in a boom, your default probability goes down. And this is a calibrated case for Argentina in 1994 and Greece 2008. So now the rows is a country. So row here is in Argentina, and this is the bottom ones are for Greece. And the first column, those are output shocks. So x-axis here is an output shock, and here is also an output shock. And in B, it's debt shock. And here in D, it's also debt shock. And in blue, it's the borrowing cost. So the interest you pay on the debt. And in orange is the default probability. And the perpendicular, like the vertical line, gray line is a baseline. So basically, we see that in the previous, we saw that this default probability increases as output decreases. We see that the increase is highly nonlinear. It's actually a composition of two sigmoid curves with a different growth rate at the beginning of the curve and a steeper one higher up, which has to do with the fact that we are basically taking exponential of a symmetric distribution, which kind of kills it a bit. And the cool thing here is that if you're Argentina and the slope of this curve, I run like a random forest analysis of what is the biggest determinant of that slope. And the slope is mostly determined by this perception of output shocks by the investors. And the higher this standard deviation of output shocks as modeled by the investors is, the flatter will be the curve. So if you're Argentina or any emerging country, basically your slope will be high because the shocks are assumed to be high, which means that you are probably early on, so Argentina had like significant probability of default at the time when we started simulating it. But as like small output shocks hit it, it moved slightly over the probability curve because the curve is not that steep. While Greece, if you think about it, Greece was here, which means that it had a high absorption capacity for shocks. So like for a very big shocks, it would still be very low probability of default. But when it started catching on the sigmoid curve, it quickly jumped up. And that's the idea. I think like in the model, that's because investors assume that the output shocks will be small. And then when suddenly there is a big one, there is a drastic increase. But I think it's in line with reality if you think about the panic that comes when a stable country suddenly destabilizes. Like it's what you said, Jeremy, at the beginning, that the crisis takes a long time and then suddenly it takes a short time. So that's more for Greece than Argentina, who everyone assumes from the get-go it's a bit crappy. And in general, so those are two countries. I also ran the model for like 10,000 realistic parameterizations and got those curves. And in 99% of them, output shocks are more damaging to default probability than dead shocks. So like you can increase that more, but if you get hit by a large output shock, that's more of a kill than the dead shock. And that's also the case for both Argentina and Greece. Okay, and the last bit is, so those were just standard relations we would expect. And there are also standard relationships between policy variables and target variables. So if you think about, so the government controls its public investment and tax rates, and it is interested in knowing how does that impact output growth and in the cost of borrowing. So we have in the model, we show that we have the standard relationships that an increase in public investment increases growth, which you should have, and that increase in taxes reduces borrowing cost because you have a new source of revenues, so that's great. But we also show something less standard, which is there are very specific and quite rare conditions, but still a significant region of the state space in which you can get that an increase in public investment can lower the cost of borrowing. So you increase investment, so you borrow more, but you borrow for less. And when does it happen? According to the model, it happens when the government can commit to a fixed investment next period. So increased in spending is only transitionary. If the amortization cost of debt are high, so basically you have already high debt environment, high principal repayments, and high interest expenditures. So there are the factors that mostly drive the spreads, not the public investment per se. And then you have that the return on investment in gross fixed capital formation is high. So that's this parameter alpha that we had at the beginning when we modeled the feedback loop between investment and output. This feedback loop needs to be strong. So you need to have that, like when you invest, the economy actually grows. And then the second thing is we show that the tax rate increase can actually increase output growth. And that's kind of, there is a whole discussion about the Laffer curve, how tax rates affect tax revenues of the government, but also growth. And we showed that you can increase taxes and still have growth under the condition that the government invests a sufficiently high fraction of those revenues in the economy. So if the government taxes and then consumes it, then it doesn't spur growth. But we can actually calculate this threshold fraction at which you start having growth. And you need to have that the government credibly commits to investing this fraction every period. So you cannot do it once and then take the money. So those are those derivatives. And the main message you're supposed to take from it is that blue is negative and red is positive, and those derivatives change signs depending on the parameterization. So there are regions, so most of the state space is in here, it's actually red for most of the calibrations, but there is a region of the state space which is non-trivial, which is blue, when you have that the increase in the public investment actually lowers borrowing cost. And in here, this is this threshold value for beta. You can see that it's it's a function of other things in the model. Okay, so to summarize, we present a tractable model for sovereign debt dynamics. It's based on the intuitive relationships between economic variables. It gives us good agreement in sample, realistic dynamics, and high predictive power conditional on output. It reproduces Argentinian default and Greece debt restructuring, which is an emerging and advanced economy, leads to realistic dynamics, generates credit ratings in a transparent way, and characterizes conditions for policy effectiveness, and it's a transparent methodology for debt sustainability analysis and for policy analysis. And that's it. Thank you so much. Yes.
So, okay, you set out to model default,
Yes.
but don't you also now have a model of sort of the fundamentals of bond prices? That is, you're making a prediction every quarter.
Yeah.
About the default probability.
Yes.
Which you would think that the bond prices should be responding to.
Yeah.
So, you should be able to use, I mean, it's not, there's still a supply demand aspect and other
Yes.
things that are gonna affect bond prices.
Yeah.
But ceteris paribus, bond prices should be moving up and down with your predictions.
Yeah, so that's the spread, right? So like our
Yeah.
spread is calibrated on historical market spread of the bonds trading in the secondary market.
Okay,
And we kind of assume that what the government issues at principal, but it pays as coupons there.
so this model is potentially tradable. I mean, people make bets on those spreads.
Yes, but this model is a quarterly,
Yeah,
it's based on, it's quarterly, not daily. So,
you don't need daily.
depends.
No, you don't even want daily,
Yeah.
you want quarterly.
Okay,
You want longer term bets so you can
but
bet big money.
also I think, I mean, those pictures that I showed you, they look nice and impressive. And I still think they are nice and impressive, but this is one run, right? Like,
Sure.
do I have any statistical significance here? No, I don't.
But you could run this model for any country
Yes.
and compare the bond prices.
Yes.
Have you compared bond price, the spreads?
So this is the
That's
bond
it.
spread. That's the spread. So
Wow.
that's the spread, right?
That's an amazing prediction.
That's the green is the data on spread from the market, and the blue is model. And here, when you have those little jumps, that's the policy activation.
Right. Now, to make a bet, you'd have to know what the GDP was gonna do.
Yes.
But suppose you didn't know what GDP was gonna do and you make a statistical estimate of the future, including, isn't there still some ceteris paribus effect on bond spreads? Even if you did a unconditional prediction where you averaged over likely GDP outcomes.
Yeah, I think I would need. I haven't tried that.
Wow.
So I
And
think
we're trying.
yes, sure. Yes, Andrea on the video. Andrea, can you go?
Yeah. So thank you for the great presentation. You are doing terrific work here. I do have a couple of questions on the modeling, actually. First one is about the GDP.
Yes.
So in one of the first slides, you show the investment dynamics. I was wondering, maybe I didn't get this. I was wondering if raising taxes has any effect on the other components of GDP in your model. Like if you raise taxes, you have also, you lower disposable income and consumption. So if these taxes are not redistributed to the economy, because maybe the government need to pay for the interest on debt, then the economy, the GDP is going to suffer. So I was wondering if you capture these other components of GDP in the model.
So that's a very key question and a very, so I'm actually kind of working now on changing the equations to GDP to include the other components a bit, because I got this feedback before that I only look at investment, but what about consumption? And we do model government spending, but there is no feedback loop from the government spending back to the GDP. There is a feedback loop in the other. There is a feedback in the other direction. So if you have a recession, the government spending goes up, and if you have like a boom, the government spending goes down because social burdens go higher when you have a recession. The taxes do, like, you have this feedback only for the investment, but you have it in the direction that you indicated, but it's only on the investment component. And yes, like we should think about consumption.
Right. Okay, so second question is, especially for Argentina, I guess, do you have any foreign exchange dynamics in the model?
So, well, it's a good period to model Argentina because you don't have to worry that much about FX because it was pegged. But then we do apply in 2000, the first quarter of 2002, the peg was released and we apply this shock, but we don't model FX endogenously. So because we model everything in real terms in the currency, in the hard currency, you basically wouldn't need to model FX. You would need to model the difference between how quickly inflation adjusts to FX. Because if you think about, so if you have a value of a house in Argentina in the housing market, when the FX jumps, does that change immediately the value of the house to like reflect its dollar value or the peso value? And for countries that rely on, that have weak currency, they quite often the value of things adjusts with that in the US dollars rather than the country currency. And we do also, if you think about the mechanism, what would FX do? Basically, FX would reduce the GDP, so reduce the revenues of the government, and that will increase its deficit. And that's done through the exogenous shock. I think like it's a battle in me whether we should model FX here or not, endogenously, or whether we can just take it from the outside. And the question is whether the costs of doing it will be justified by the benefits of including it in the model. Yes. Owen.
Yeah, fair enough. Yeah.
Oh, sorry.
I mean, if you need to model the countries that borrow in foreign currency, maybe it's worth. If you stay like in the Eurozone, then okay, I agree. You don't need to do that. Anyway, thank you.
Yeah, cool. Well, we'll come back to you, Owen. Yes.
Just wondering,
Yes.
so is the model flexible enough to incorporate things like balance sheet risks? Because when you're talking about fiscal metrics, they get to GDP.
Yes.
But then there's all these SOE debts, all these guarantees.
Yes.
Can you be able to plug those also there?
So you can. So, but well, there are a few things. One is, well, I didn't talk about it much, but we have also, apart from, we have the social spending, which I think is called the government spending. And we have this mechanism that this government spending increases when you have a recession, which can represent, for example, climate damages. Like if you have, I don't know, like a shock, like a flood, then the government pays for the recovery. But it also can represent guarantees to banks that default and the government is actually covering their bankruptcy. So it's not explicit in the terms of we actually don't model the banking sector or the guarantees themselves, but like the mechanism is kind of there. And also because the model is quite flexible and quite small, you can basically plug an additional stream of costs that just goes directly into the deficit. And then the question is whether you want any feedback loops. But yes. Owen, last question, and then we'll go because I ran over time.
Sorry, in the particular cases you're highlighting, an FX model and a sovereign default model are the same model, right? Like that was what anybody was pricing, was that, I think. But well, you probably have a more sophisticated take on that than I do.
So the issue with, for example, Argentina, if you looked at the figures themselves, like the debt, so like there is a question of, okay, how does the principal parity value of debt increases and how the FX denominated value of debt increases, right? And then like in the model, our spreads start rising even before the FX shock. So you'd kind of like have this high like risk scenario without putting the FX in. But like because the FX was pegged, you don't see the gradual realization of the FX risk, right? You have like the release of the peg and that's when it hits. I think
people anticipating when the peg's going to break and people anticipating when the government's budget is gonna break.
Also, you know,
Kind of the same thing, right?
the fact that the official peg was still in place doesn't mean that the people were evaluating their houses on the market with the peg, right?
And also they were, you know, they were starting to corral the currency deposits.
Yeah, exactly.
So it was a messy
Exactly.
sort of thing, but I would imagine that it would actually be, if you're looking for an extension, separating out the official and private sector financial flows. If, I don't understand to what degree that's already implicit in what you've already done, but that might be a real win in terms of having a customer. Being able to treat the IMF package as exogenous means you treat that as a control variable. And so you're building a model for use by 3 different parties in that negotiation.
Well, I kind of, I first want to get one party to use it, you know? And also, I think one of the big extensions that would be useful to have is the lender of last resort, which we don't have currently. So we don't have IMF in the model per se.
Yeah, and that's my,
and that would be,
that's my suggestion is having IMF in the model.
But with those bodies, it's not clear. So, for example, with modeling governments, governments often don't want to be modeled. They
Right.
want to be able to see how their actions will affect everything else, but they don't want their actions to be in the model itself. So I think, well, there are loads of things to.
Yeah, so I would suggest that what you leave as the control variable is the IMF decision, not the government fiscal policy.
I see.
Right. And,
Hard.
and
Yeah.
not that it's a like,
Yeah,
you know,
yeah.
hard choice that you don't
Yeah,
have to
yeah,
choose
Sure.
to have one of them always be the control, but I think it would be a good thing to aim for is to have the official, the IMF
Yes.
decision, at least modelable.
Yes, I agree. Okay, I don't want to keep you guys too long, so that's the end. Thank you.